markets thought that Fed Chair Jerome Powell said something crazy today. And it didn't have anything to do with shutting the blank door when protesters once again jumped on stage. They were clearly moved by something because they had a strong reaction, but did he actually say anything? Did it make the slightest bit of difference? Or was this reaction just the markets being jumpy in a kind of intraday, not really mattering for anything thereafter kind of way? That's what we're going to figure out here and go to see why they reacted, what the reaction actually amounts to, if anything, and then consider, well, if it doesn't matter, then what's actually going on in these markets and what's actually going to move them in the coming days and weeks. Welcome. This is, of course, Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we'll begin with exactly that. So, did Jerome Powell actually tell us anything? Well, let's consider. Here was the start of the reaction. So this is the S&P 500, just as a kind of benchmark for overall risk sentiment. Shares were already inching lower today in the wake of a 30-year bond auction that didn't go quite as well as markets expected. But you can clearly see here from the market response, they got a bump lower. They had been somewhat paused and dissecting that bond auction after a little bit of a nudge lower, and now looking, once Powell came in, to be stuck near still lower lows for the day. So clearly they did not like it. Similarly, the U.S. dollar roared higher when Powell made these comments. Now, did he actually say anything that was different? Did he actually suggest that anything had materially changed? Let's keep looking. Here's the 2-year yield. And just to clarify, of course, we're saying the dollar roared higher. This is the euro. So, of course, the euro going down here is it going down in U.S. dollar terms. The euro is the most liquid major counterpart for the dollar. So we're looking at the 6E future here as a kind of dollar direction indicator. So it going down means the dollar is going up, just so we're on the same page here. Here's the 2-year note, ZT future. This is 2-year bonds, and of course bond yields and bond prices move inversely, so same logic here. Powell speaks, and we get a sharp move lower in the 2-year note. That means yields at the 2-year level, the 2-year maturity, the one that's the most sensitive to Fed policy expectations, it, not surprisingly, shot higher. So, again, we get the sense that whatever Powell said was read by markets as relatively hawkish, as relatively likely to mean higher borrowing costs, as relatively likely to mean more support for the U.S. dollar, or so it would seem. We get still more confirmation that this seemed to be the case, even in gold, which is already muddied by geopolitical risk. So to see it respond, however muted, was still more telling. The markets were looking at this and saying, okay, even gold has reason to come in a little bit. Now, it didn't fall too much because there's still a degree of geopolitical risk premium that's baked into it around the conflict between Israel and Hamas. But nevertheless, there is something of a reaction. Now, what did Powell actually say? Well, he was speaking at a conference, the annual conference held by the International Monetary Fund, the IMF, and what he had to offer was not terribly different from what the Fed typically has been saying for basically the past 6 weeks to 2 months. So he was, quote, gratified that inflation has come down. He cautioned, though, that there's still a long way to go. And indeed, inflation is not at the 2% target, so we knew that. Perhaps the most critical tidbit here was when he opined that the Fed is not confident that they have achieved a restrictive enough policy stance to get to 2% inflation. So interesting verbiage, in the market perhaps read that as being a little bit more coy about the rate hike cycle being over and a little bit more open to the possibility of hiking again. The Fed chair warned that inflation has given us a few head fakes and progress is not assured. Nevertheless, he cautioned that the Fed is going to move carefully here because they want to avoid the risk of over-tightening. So the key question, of course, is, does this mark anything different for anyone? Is this in any way not what the Fed has already been saying for quite a while? Well, first, let's consider the dynamics of what it is that markets do in the face of this kind of news. So here is the implied Fed outlook between the last remaining Fed meeting of this year in December and December of next year, as implied into Fed funds futures. That's the gray bars that you see there. And you can see that from June, so from mid-year through to now, there's been a trend toward diminishing rate cut expectations. So the gray bars have become less negative over time. As they became less negative over time, we also saw stocks come down. It should make sense. If rates are going to be higher than people expected because there's going to be fewer cuts than people expect, then the cost of capital is going to be higher, so financing any kind of economic activity is going to be more expensive. So earnings generation and financing those earnings is going to be that much more difficult. So not surprisingly, as we've had a diminishing outlook on rate cuts here, you can see the gray bars are getting shallower, so too the S&P 500 has come down. Now, most recently here, if we look at what's happened since the September FOMC in particular, is there seems to have been a little bit of a leveling off, and rate cut expectations have started to kind of drift back in. So we've started to have a little bit more here, and not surprisingly, you can see when rate cuts get narrower, stocks come down. When rate cuts get a little bit juicier, they come up. When they get narrower again, stocks come down. When they get juicier again, stocks come up. And that was, of course, the story of last week. We had the FOMC announcement. The Fed gave us nearly the same exact rhetoric as Powell gave us today. So caution, 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 disclaimer, 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 but we're probably done with rate hikes. And so stocks roared. And you can see that a bit more of a rate cutting sort of outlook entered into the picture. To check our logic here, just to make sure that we're looking at, in fact, what we think we're looking at and not something incidental, we can cross-reference with the US dollar, which predictably is telling us exactly the same thing. When you get fewer rate cuts, the dollar has a greater yield advantage. It goes up. More rate cuts, it comes down. Fewer rate cuts, it comes up. More rate cuts, it comes down. And so, of course, as we've seen a little bit of a hemming in rate cuts this week, So too the dollar has come up. So in that sense, the response to Powell perhaps makes some sense. He issued some sort of modest hawkishness, arguably not any different than the qualifying hawkishness that was there at the FOMC meeting. But does that really change the bottom line? Here's how the yield curve has evolved since the last FOMC and versus a week ago. Now, of course, the last FOMC was a week and a day ago. So there's not really that much difference between what's happened since the last FOMC and a week ago. It's basically the same set of days. But the important thing here is you can barely see those dashed lines here relative to the solid current conditions line. And that's because almost nothing has changed. The Fed policy outlook has barely budged. It still looks for, basically, rate standstill for 6 months, and then the start of easing in the second half of next year. What does that look like? Well, at this point, you can see the priced-in probability of another hike in this cycle peaks out at 26%. That's a 14% chance of a hike in December, in addition to a further 12% chance of a hike in January. Taken together, that's 26% chance of another hike before cuts begin. And then cuts enter the picture in a hurry. So you can see here, at this point in June, the likelihood of a cut is already 76%. So that's 35%, almost 36 if we do a bit of rounding in May, cumulative with next to 50 in June, cumulative with about 17% already in March. So take all this together, and by June, one rate cut is almost certainly on the table. That rate cut is fully baked in by July, so we're definitely, as far as the markets are concerned, going to get at least one by July. And by then, there's already a 30% chance of a second. That second is fully baked in by November, though it is 87% likely in September, so very likely. And then come December, we're looking at least two, but a 97% chance of a third, which is almost certain in Fed terms. So we're looking at this point at an outlook that isn't really very much changed. It's looking at 75 basis points in easing starting mid-year. Now, as it happens, this is also not very different from most other central banks, many of which have signaled that rate hikes have ended. Just over recent weeks, we have heard this message given by the Bank of England, the ECB, the Bank of Canada. The RBA actually lifted rates this week, but made a real big point out of this is probably the last one. And in fact, the Australian dollar tellingly fell after the hike. So we're looking at a situation here where global central banks are starting to wind up these rate hike cycles. And the Fed and Powell's speech today, despite the market's kind of knee-jerk reaction to its initial fractionally hawkish tilt, they don't really seem to be particularly moved. They don't particularly think that anything about any of this is different. And it makes sense why. Because when we're looking at where we are on global economic growth, it's relatively plain that we're flirting with recession. A recession that central banks, in large part, engineered themselves. And for good reason. Inflation was running hot, and the Fed led most major central banks on a campaign of reining it in. We saw very significant interest rate hikes from not just the Fed by any stretch of the imagination, but also the Bank of Canada, the Reserve Bank of Australia, the Bank of England, the European Central Bank, on and on and on and on and on. The places, incidentally, where there wasn't a significant tightening regime were also the places that didn't have significant fiscal spending to do to backstop their economies during COVID. So emerging markets. And of course, those emerging markets are in large part dependent on developed market demand. So that extra demand that was created by all that extra fiscal spending helped those emerging markets to not have to do much of their own fiscal heavy lifting. And many of them couldn't afford to do it, couldn't borrow nearly with the same abandon, nearly with the same vigor, and spend nearly with the same generosity that fiscal authorities in the developed world did. And so, where we are now is all those central banks have had to push the brakes to get that inflation reined in. That's where we are currently. We saw that there was a bit of a pop in growth at the start of this year, driven by the service sector. There's been a lot of describing of it as a kind of revenge, quote unquote, spending. A lot of it went to services like travel, restaurants, concerts, various other kind of post-COVID services that perhaps people were holding off on and now felt like they could finally re-engage. A big part of that was China reopening in December of 2022. And that, of course, helped because an absolutely massive population was let out of near nationwide lockdown and told you can now go back to stores and events and travel around. So there was a pop there. But as we can see, it crested quickly. And as we went into mid-year, all of that pop in services, a transitory pop in Fed parlance, had already started to wither. And as we look at where the global economy is now, this is a PMI index, which, as ever, operates on a logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What we're looking at here is so close to 50 as to be almost at standstill at a global level. So it's not surprising that all of these central banks are starting to say, okay, time. This is it. Inflation has been falling. Growth is at near standstill. It takes 12 to 18 months for any given rate hike to work itself through the system, which means there's a ton more tightening that's still in the pipeline that's going to come and hit in the coming months. Let's not do any more. We've done enough damage. This is going to get inflation to where it needs to go. So not surprising, really, that all these central banks, including the Fed, very much echoing what Powell said today, are paying lip service to the fight against inflation because they don't want inflation expectations to get out of hand in a premature way and undermine what they're doing, but also that they're done here. And this is where things get interesting. This is where the price action starts to look like an opportunity. Because what we saw last week around the Fed's near confirmation of exactly this kind of thinking is a dramatic upsurge in stocks and a dramatic sell-off in the dollar. Bonds, of course, also roared higher. Yields cracked down. This week, what we've seen, with an absence of really any kind of meaningful macro information other than things like this Powell speech, is a bit of a correction after that sort of intense volatility. It comes against the backdrop where all of this central bank action has so aggressively driven down expectations for economic growth, and indeed, it has been fizzling, as we've just seen, that economists and market watchers seem to have overshot. And so what we've now been looking at over recent months, in particular since September, even perhaps since August, is that the flow of global economic data, both in developed markets, the orange line, and emerging markets, the red line, has not only improved relative to forecasts, but is actually at this point tending to outperform them. So that these indexes are all above zero is telling you that economic data is tending to overshoot baseline forecasts. It's telling you that economists looked at what central banks were doing, looked at the implications of it and said, well, this is going to be terrible for growth, and ratcheted down their forecasts to such lows that they overshot, as frequently happens, both on the upside and the downside. So what we end up with here then is a situation where not only does it look like everybody is going to hold hands and march into a recession together, but also that the severity of what's going on is a bit overstated, at least as far as expectations for economic data are concerned. Now, with that in mind, we probably are looking at a situation, again, provided that Powell didn't change his tune, and looking at the yield curve dynamics as we just did, the markets don't believe he has. Here we are. That these lines are all so clustered tells you the markets see virtually no change today versus when the Fed talked to us a day over a week ago. It tells us that capital at this point might well start to say, well, things are not as bad, so risk on. We're going to go look for opportunities to make money in the markets. We're prepared to put money at risk in these markets. We feel good about that. As long as the Fed doesn't pivot on us, and it doesn't seem like, again, that the Fed did, despite the market reaction, knee-jerk though it was. And so the trend seems more so what happened last week. And the correction in that seems more like what happened this week, rather than a change of that underlying dynamic. Now, in practical terms, this implies that stocks have more to go higher, the dollar has more to go down. But the way that markets have been performing since the beginning of the year would suggest that the opportunities to be had in markets are not all created equal as this recovery occurs. Because if, in fact, the Fed is done, if it is ready to join other central banks, as would seem to be the case, then there is some opportunity for bargain hunting. U.S. economic growth has been outperforming by a long mile, and indeed U.S. assets have been outperforming. You can see here a range of regional ETFs. The baseline is the green U.S. one, SPY, Eurozone, ETF, EZU, UK, EWU, emerging markets, EEM, and a kind of broad Europe, Australasia, and Asia ETF. So essentially a sort of non-US benchmark, a kind of key growth regions ex-US ETF is how I would describe EAFE or EFA. So if you look at how those have performed, they've performed, of course, materially worse. They're still down on the year, whereas shares in the U.S. are not up as much as they were at mid-year, but certainly still up by a healthy amount. And so if it is in fact the case that everybody is going to now abandon rate hikes together, and that everybody is going to recession together or some kind of an economic downturn together, then this divergence might well give way to some reconvergence, as long as the Fed is indeed done, as long as the divergence is indeed ending. And that creates opportunities and suggests that what might be a byproduct is that capital moves out of U.S. dollar denominated assets and goes to where risk buying is cheapest, to where things are on discount. And that is seemingly anywhere but the U.S. Now, what's interesting is that not only does this imply a flow out of U.S. stock markets, or at least an underperformance by U.S. stock markets. This by no means suggests that U.S. stock markets are going to fall, just underperform relative to alternatives in Europe and Asia. But that the currencies underlying these assets might do better against the U.S. dollar, because capital flows will move from things denominated in USD to things denominated in not USD. And interestingly, whereas rate cuts typically hurt a currency, you might see in this environment where everybody is going in that direction simultaneously, markets rewarding central banks for getting to stimulus closer with a stronger currency. Because the faster the stimulus comes, the faster the recovery in that area, the more attractive the financial assets in that area, the more capital flows there is into the currency needed to buy those assets. And so tellingly, over the past 2-3 weeks, what have we seen? Dovish ECB, euro goes up. Dovish Bank of England, pound goes up. Rate hike from the RBA, Aussie dollar goes down. Now, that might seem counterintuitive, but not in a world that puts a premium on stimulus sooner rather than later. And so the general dynamics here might well be exactly as last week suggested, and not as the post-Powell response implies. That indeed stocks have more room to go higher, the dollar has more room to go lower, and if one were to look at which are the stocks that are likely to do well, it is non-U.S. markets and their ETF proxies that outperform, at least for now. And that is macro money for today. We had a bit of an abridged week for the show this week. I was out for a few days with strep throat, but I'm back now. Thankfully, antibiotics are your friend, everybody. I'll be back next week as usual. The show will be back to Monday through Thursday, as ever, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happens in markets on any given day and trying to find the logic and then think about what might happen next. I'm on again with Chris tomorrow, as I am every Friday, for Futures Power Hour. Then on with Tom and Tony for First Call on Sundays. Writing for the News and Insights section of tastylive.com. And sporadically opining on the platform formerly known as Twitter, @Ilya Spivak. Happy trading. See you tomorrow.